But our next speaker, Vishal Jain, he will keep you in a good mood, because the topic we have given him as a very important batsman is regarding audit reporting, SA700 and all that. Friends, before I introduce Vishal ji, I will tell you one thing about SA700 reporting. This is the only SA which is need to be complied for the reports which goes to the all stakeholder outside our firm. Other sampling, risk assessment, everything remains in our file. But this particular essays, reporting essays are applicable for the things which goes to outside. So we have to be very careful. And for that, to empower us, to enlighten us on that, we have a very capable speaker today, CA Vishal Jain. I will briefly introduce him. He has over 14-year experience post-qualification. He has done in Masters, MCOM and then CA. And it is across the industries. He has like automobile, ancillary, IT support service, power generation, software development, manufacturing. Across the industries, he has done various audit assignment, and mainly statutory audit, tax audit and internal audit. Currently, he is associate partner in the through leadership team in his firm, and he also frequently deliver the lectures at WRC. Also, some of you must have heard him last time on SA 230 documentation. So, one last but not least, he has come travel all the way Pune to enlighten us on this particular topic of reporting. So, with this brief word, I welcome sir, C. Vishal Jain sir, and request my colleague Hitesh to present memento to today's speakers. Over to you and all yours, Vishal ji, please.
Hello everyone. First of all, I'd like to thank all of you to stay back and listen to this on a very rainy day. It's a Saturday with a World Cup followed finals. So thank you for that. I'll try to make it more practical. So what I've done is, though I've covered few slides on theory, we'll run through it, but we'll focus more on practical elements, practical aspects, and what are the mistakes we have seen. So that is the coverage that we briefly plan here. The topic for me today is audit reports, key audit matters, modified opinion, emphasis of matter, and other information. Okay, that is the topic. Though audit trail is not part of this, I've just included briefer so that at least we have a flavor of what is the reporting expectation here. Okay, with that, let's start. So this is what we are going to cover. First is introduction. So what are the essays relevant for us for reporting? Then we look at the contents of the audit report. What are the headers? What are the contents? So we get an idea of the audit report. We look at the flow, how the flow happens. What is comes after which para comes after which para. Why? What is the relevance of that? We'll go to the reporting 143. We'll go to IFC. Look at going concern, no going concern basis. Console audit report. Few quick updates or takeaways as the case may be. We'll look at broadly on difference between a general purpose financials and a special purpose financials. And lastly, I've just included a slide of, there's a lot of material from ICI on reports. So I'll just put a slide of all reference material available to us if you want to deep dive on any sessions. Okay. So that is a brief coverage that we have planned today. Standards. So these are the standards that we are looking for today. One is SA 700, forming an opinion. That's the basic. 701 is key audit matter. Okay. 705 is modifications in the audit report. 706 emphasis of matter, other matter. And last is 720, other information, our responsibility on the other information. So that is the bouquet of standards relevant for us for this topic. Flow, what are the contents or flow of the audit report? Okay, we start with the title. It starts with a independent auditor's report. That's the title. Addressee, who am I addressing to? The audit report. That is there. The opinion paragraph starts, comes after that, and then basis of opinion. Okay. Then we go to material uncertainty paragraph, EOM, key audit matter, other information, management responsibility, auditor's responsibility, other matters, other reporting requirements 143.3. and last is signature, date, and sign. So these are the contents. Now let's deep dive into each topic. As I told, I'll just briefly touch upon the requirement, but we'll more focus on practical elements here. Okay. Title, the practical challenge or the mistakes that we have seen generally is the title itself is missing. The title of the report should be Independent Auditor's Report. So that is missing in a lot of cases. So that's the first part on the title. Okay, nothing more to add there. Addressee, that is also important here. So for Stat Audit report, if you're going as per SA, it's the members. So we are addressing the report to the members. In few cases, what we have seen is people are addressing it to the board of directors. So as per SA, you cannot address to the board of directors. It has to be to the members. Yes, if it's a special purpose, then you can address to the management or the board of directors. But if it's a general purpose financials, it has to be addressed to the members. So that's on the addressee. Okay. 700. So here, unmodified opinion. When do we give an unmodified opinion? One is when the financials are prepared in non-material aspects in accordance with the applicable framework. It could be Ind AS, it could be IFRS, it could be AS, etc. If it is as per the framework, it gives a true and fair view, then it's an unmodified opinion. But yes, if we come across some material misstatements, and we conclude that the FS is not free of material misstatements, we give a qualified opinion. Okay. Or if you are unable to conclude as well. So, for example, we are not getting audit evidence, then also we give a modified opinion. Okay. So that is a basic distinction. We'll go into detail into different slides. Some examples of qualifications, frequently. So this is not an exhaustive list, but generally what are the qualifications we have seen? One is FEMA non-compliance. I think earlier speaker spoke about, not getting the dues in time, debtors, creditors, etc. as per the FEMA requirements. So, that can be qualified if, no steps is taken by the management. If some steps is taken and, its subsequent recovery is there, we can even evaluate putting it to an emphasis of matter. But otherwise, if we don't get the money and it is repetitive in nature and client has not taken any steps, then it warrants a qualification. Non-compliance of any Ind AS, AS, etc. For example, they are not complying with, say, inventory valuation. So inventory is not valued at cost to NRV, which is lower. So that warrants a qualification. So any non-compliance with any standards, that warrants a qualification. So that is another example. Non-compliance of Companies Act, for example, large, which are material non-compliances, for example, annual returns not filed for last 2-3 years, etc. There is a debate in our fraternity whether we should put it in the qualification section or whether we take it to the legal and other regulatory matter paragraph. Generally, what we have seen is if it is very material, then we bring it in the qualification. Otherwise, we put it there under other legal and regulatory matter. Okay. So there are different views here, but that is the general stand that I have seen more frequently. How material it is, based on that, we take a call where to put in. Okay. Impairment of assets, a lot of cases we have seen, there are indicators we spoke about in the earlier session. So if these indicators are not justified by the management and there are some issues, heavy assets, for example, some manufacturing industries, the PPE value is very high, and then we tend to go for a qualification. Physical inventory, if we are not unable to do, and through a alternate procedure also we are not able to get audit evidence, so then that is another area of qualification. Recoverability of investments, so I think impairment, recoverability, similar things, or even last part is, recoverability of balances from related parties, loans, advances. If you are not able to assess the recoverability, valuation assertion that we are speaking of, that is another point for qualification. Actual valuation, a lot of times we have seen that, companies don't want to spend on the actual valuation. So they are saying if you want to put it in the qualification, it's a private company, it doesn't matter to us. Why do I spend some money on getting a report? It's as it is a private company, family-owned company, so it doesn't make sense. So that is another area we have seen where qualification is given. And qualifications in subsidiary. So, for example, you're giving a console opinion, there is some qualification in the subsidiary. So you bring it here also. There are two options. One is to reproduce, or one is to get a summary as well. Of course, this is subject to our evaluation at a console level, whether that qualification is material at the console level also as well. So, for example, it may be material at the component level, but it may not be as material for us at a console level. Then you can ignore that. So it depends on your assessment at the console level based on the console materiality. Okay. So these are some examples. Difference. The major difference here is when do you qualify, when do you give an adverse opinion. So this is a chart given from the it is there in the standards itself. I've just put it here. So for example, one is it depends on whether it's material and whether it's pervasive or not. Okay. So one is if the financials are material misstated. So one is if it is not material, it doesn't matter. We need not get it in the audit report. So we always determine one is the overall materiality, and then is the performance or planning materiality. If it is below your materiality, then you need not even qualify. But if it is material, then only the question comes whether we need to qualify or not. Okay, so that is the first assessment. Once you have decided it's material, now we have to evaluate whether it's only material but not pervasive, or whether it's material and pervasive. It depends on whether we are getting evidence or we are not getting evidence. So if financials are misstated, but it is material but not pervasive, we go to a qualified opinion. And if financials are misstated, but it is material and pervasive, we go to an adverse. Similarly, next case, we are not getting audit evidence. And it is material but not pervasive, we give a qualified opinion. And if it is material and pervasive and not getting evidence, it is a disclaimer. So that's a chart given simple to understand, is there in the standards. Okay? So that is the yardstick. A lot of comments are coming around this, even in NAFRA. So they are saying that, one is obviously, which was covered in the morning. One is that people trying to hide a qualification through emphasis of matter. So that is one observation. Secondly is, you're giving a lot of qualifications, but, if you put together all the qualifications, it becomes, it is very material. So can you still say that, subject to all these qualifications, is it still true and fair? Or you need to go to an adverse or disclaimer, as the case may be. So that is another NFRA observation, that, your assessment should also be documented, that yes, it is material, okay, but how pervasive it is, and whether you need to give a qualified and stop there itself, or go one step beyond, evaluate for adverse opinion or a disclaimer, as the case may be. So that is another observation. Okay. What is pervasive? So pervasive is, it's not confined to few areas in the financial statements. So for example, let's take a simple example. I have done the audit and I've concluded that only debtors is an issue, debtors valuation is an issue. Otherwise, I'm comfortable with the other areas of the financial statements. So I'll say it is material but not pervasive. But let's take another example where, there is a going concern issue itself. So it is not restricted to one FSA. It will impact everything. For example, if there is a going concern issue, like we spoke about the spectrum in the morning, it will not only impact that, it will trigger impairment at PP level. We have to see the recoverability of other balances, etc. So it will not only impact the PP, but it will impact a host of other FSAs. So it is material and pervasive. So that is how we look at it. So it's, if it is confined to one area, then it is only material, not pervasive. If it is not confined to few areas, but it is spreading more, it is affecting a lot of financial statement areas, then it becomes pervasive. Second area, it could be still restricted, but the amount is very significant. So let's take an example. Typically you have seen in a power generation company, your value of PP is very high. So your technically your investments in this windmills or etc. would be 80% of your total assets. In that case, though it is one single line item, but it's very material as a FSA because it's forming 80% of your balance sheet item. Then it becomes material, though it is restricted to one FSA line item, but it is material in totality. So then also it becomes pervasive. And last is an issue with disclosure, which is fundamental to the user's understanding. So that is also termed as pervasive. Okay. So let's take a simple example. Earlier we discussed going concern. If the management is not willing to disclose, so that also becomes pervasive because it will not impact one of your FSs, multiple. It will affect the entire financials per se. So your user's understanding of the financial itself is an issue. So that is another example of pervasive. So these are the assessment of how you do the pervasive. Very critically, very important to put this documentation, because what has happened is we are good at doing the assessment at a standalone level. So every misstatement that we identify, we are able to conclude at that level, misstatement, and we are okay with that. But how do you look at it in aggregate and see whether it is only material or whether it's material and pervasive? That is the assessment that is missing in a lot of cases. Any questions so far? Feel free to stop. In case you have value adds, happy to discuss that and share with others as well. So please feel to interrupt me as soon as you have something to share. Practical aspects on the opinion para. Okay. So one is when we write the opinion, so we write we have obtained all information. So we write we also have to write and based on the consideration of the other reports. See what happens, for example, in a console report. You are also not only opining on your report, but you are also taking the reports of component auditors, probably you're taking reports of branch auditors. So adding this in the opinion paragraph saying that, based on my testing as well as on consideration of the other reports, this para is missing in a lot of cases. This is okay? You are able to link to this para? Okay. Okay, so consideration of other report is generally missed that we have seen. Okay, next is this reference. So what happens is we do the audit as per section 133 of the Companies Act. Now if you go to the sub rules, there is one for AS, one is for Ind AS. So for example, if you go to Ind AS, there's rules 2015 as amended. If you go to AS, it is Company Account Standard Rules 2021. So what type of mistakes we have seen is this is not updated. So also here we have seen is missed practice. Some are just restricting to saying it is 133 of the act, that's it. If you are extending beyond saying, no, I also want to give reference to the rules, which is relevant. So anyways is okay. Generally we have seen is people prefer clarifying with the rules, but the challenge here is that rules is not updated. So for example, what the challenge I've seen, one is, let's take an example, it's an AS client, but then it has adopted, it has crossed the threshold and now it has become an Ind AS client. But people are still using the AS thing, so references of the rules. So that is a mistake that we have seen. Second is another case where what we have seen is, if you see IGAP was amended in 21, but what people are doing is using the audit reports of previous years. So the old rules reference is still continuing. So ensure that this rules reference is updated. Specifically, 21 is recent. So IGAP we've seen a lot of issues where people are not updating the rule references. Okay, that is it. Second is, when we write the opinion, we say that, statement of profit or loss. So we have to conclude on that, whether it's a profit or loss for the company. So what is happening is people are just writing profit/loss, not concluding. If it's loss, delete the profit word. So that is another mistake that we have seen. Okay. Next, material uncertainty we'll cover separately. Don't use the word subject to. So we are giving an opinion, saying that the financials are true and fair view. Okay. So don't write subject to. If it is a qualified, then use the standard wordings. We'll go to the wordings also. Specifically write that this is the qualification. What is the base of qualification? Write specifically. Don't use subject to the above, because what is happening is people are saying no, everything is correct. This financials give a true and fair view subject to my comment below. So that is not allowed. So give specific reference, give a qualified opinion. We'll look at the reference and how the wording should be. We have given some examples as well. Okay so far? Okay. Basis of opinion, some practical elements or mistakes that we have seen. Don't start it with we draw attention. See, normally when we, this is the wording for an emphasis of matter, saying that, something is disclosed already in the notes to accounts and we are just drawing reference to that. So don't start with we draw to, because it is the wording for an emphasis of matter. You qualify or use the wording for qualification. We look at that separately, but don't use we draw attention to. Okay, that is the first part. Secondly, yes, what happens is in many cases, qualifications will also have a note. So, audit report is our domain, notes to accounts is client's domain. Okay, so they would prefer to put it in the notes, but however, we also need to give it in our audit report. So what has happened is, in many cases we have seen, people are just, management is giving in the notes and we are just not drawing bringing out the crux of that matter. We are saying refer note this for the qualification, that's it. So bring it out, summarize it, but bring it out, that matter in the audit report itself. Don't just say that, it's referred in that, refer to that note and close it. Bring out the fact, bring out your assessment as well in the main audit report. Also, you may not always agree with what is the wordings given by the management. Second issue here, what we have seen is, people are just copy pasting the same note. So management will write a note, same wording will copy paste in the audit report. That is not the case. That's the management, our note is different. So it should be our assessment. So ensure that, we write our wordings, what is required in the audit report. Avoid using the word management is confident. So, a lot of cases we have seen that, going concern specifically, when we write, so, or even in other cases, I'll give an example. The earlier session we discussed that, debtors and creditors balance are subject to reconciliation and adjustments if necessary. Okay. And then we write below that, management is confident that, these amounts are recoverable in the ordinary course of business. That is not allowed, because this is our audit report. Why do you want to bring management assessment here? So just state the facts, that yes, I have not got confirmation. Do perform your audit procedures, alternate procedures. If you're not getting, then qualify. There's no midway. And don't give management commentary in the audit report, saying that, management is confident that these are recoverable. Don't try to justify management. This is our report. So let us be very clean and independent of management assessment on these aspects. Okay. Okay. Impact should be quantified unless impracticable. So, for example, you're saying that, there is an qualification. Let's take an example, inventory valuation. They are accounting, I've given an example. They've accounted it on a cost basis, not at NRV basis. So what is the impact of that? Just quantify that also. There's a QRB commentary on this saying that, a lot of reports are giving open-ended qualifications, but not quantifying. So, when we do not quantify, then, user will not understand what is the impact of that. So ensure that this amount is quantified unless it is impractical. Okay. A logical thing comes to mind is that, if it is possible to quantify, why not adjust it? Yes, logically it makes sense to adjust it, but sometimes management is not agreeing to adjust. Okay. So then we have no option but to qualify. In that case, we have to quantify. Okay. If there is a qualification that is being repeated in the next year, we also highlight saying that, this was also qualified in the previous year. So add that paragraph. So that is another case missing. So continued qualification, we should even highlight it to the user saying that, management is not doing anything about it. So it's a repeated qualification. So give that sentence saying that this was also qualified in a previous report dated this, issued by us or something like that. Okay, add that paragraph as well. So here, there's an ICI publication on significant audit matters. That's a wonderful publication. It is a synopsis of a lot of audit opinions, scams, EOMs, multiple incentive paragraphs. So yes, please refer that. Just a request is don't directly copy paste. It may not be applicable as it is, to us. So ensure that you customize it. Yes, you can take reference, please do. But ensure that you customize to your client requirements and modify accordingly as applicable. Okay. I think we discussed the last point, balance is subject to reconciliation, so don't add that, okay? So you have to perform. So, if you're not getting confirmation, perform alternate procedures. You get comfort, great. If you don't get comfort, then qualify. There's no two way about it. You cannot say that, it's subject to some reconciliation or subject to confirmation, etc. Either you're satisfied or you're not satisfied. You cannot be midway, okay? So far, so good? Okay. So illustrative guidance, I've just pulled out some examples of how to draft, So for example, this is a qualified opinion. Okay, one or two things I'll just like to highlight here. So here, this point, if you can see here, profit oblique loss. So the point I was referring to, the standard says profit or loss. You have to customize it, whether it's profit or loss. That is not coming out, okay? Second point I was talking about, reliance on branch auditor, component auditor. So it is coming from here, in our opinion. So second paragraph, in our opinion and according to the explanation given to us. And then you add that para, and based on the consideration of report from the branch auditor, component, etc. So that has to be brought in here. Second paragraph, first line. After explanation to us, add that paragraph here. Okay, I'm just trying to link to what we have discussed to practically how it is shown on the audit report. Okay, that was there. Then we discussed, don't write subject to. So we are saying giving except for the effects of the matter as described in the basis of qualified opinion. So we discussed, don't use subject to wordings. So write except for the effects of matters as described below, and then give the detailed qualification here. Okay. Now we go to the basis of qualified opinion. So this is an example of inventory which we spoke, that cost and NRV is there. It is accounted at cost, NRV effect is not taken. So here we are quantifying. If you see, I'm just putting excess here, but yes, we are trying to quantify that amount, that, this is the impact of that. And what are the FSS getting affected? So we are also saying that, if this adjustment would have been done, cost of sales would have increased by this amount, income tax effect is this much, net income, shareholders fund will reduce by this amount, etc. Okay. Next is, if you see refer XX of the financial statements. So we are acknowledging that there may be a note in the financial statements, that is okay, and we are giving reference, but we are reproducing the qualification. We are not just saying that refer there and close it. We are giving that elaborate, qualification in our report. So that was the point I was highlighting earlier, okay? And if you notice, we are not using we emphasize or matter on. So we are not giving reference directly to that. So we are specifically mentioning the facts here, clearly here, okay? So far, so good? Scope limitation. So I think we discussed briefly, what I'll just quickly touch upon. So what happens, let's take an example. I have already taken the audit engagement, and now management is saying, don't do this, don't circulate confirmations. I think that was the example covered earlier as well. So first is, if there is a scope limitation, first go and talk to the management saying, what is the issue? Why are you saying that don't circulate confirmations? They need to justify to us. And like the examples given here in the morning session, that yes, there could be a legal case, etc., where we don't want to just give a stand or something, that is still justifiable. If not, then we have to go and escalate. So where do we escalate? Those charged with governance. Go to them and tell them, and try to explore alternate ways to do the testing. If great, if that is okay, perfect. If it doesn't happen, then what is the next step? So let's take an example. We have already escalated to TCW, and they are not able to help us. We are still not able to get. Now determine what could be the impact of that scope limitation. Is it material but not pervasive? If yes, then qualify. That's okay, because it's qualification restricted to few areas. It is not pervasive, not affecting the entire to and fair view of the entire financials. So we're still okay. It's a limited area. We can still qualify and move out. That is okay. If not, it is not possible to effect, or if it is material and pervasive, then first is, it says withdraw from the engagement if permitted by law. Okay. And last is give a disclaimer. Okay. Saying that we are not expressing an opinion itself. So if you see here, technically the first way out it is saying is, obviously discuss with the management, those charged with governance. If it is material but not pervasive, qualify. If not, first go to a withdrawal mode. Try to go for a resignation mode. And if not, then only give a disclaimer. Okay. So that is the hierarchy. So here what I've seen is, people are still going ahead with the audit and they are giving an opinion. But if you read the standards technically it says no, first try to, move out from the engagement, give a resignation and move out, okay? So that is the scope limitation. Obviously, after the engagement, we have started the engagement. The engagement is awarded to us. We have already entered into an EL with the client, etc. And then these are the issues that is faced. So that is the issue, way out. Okay. Going concern. So I think it is covered in detail. So I will just quickly rush through it. But it was covered in very detail in the morning sessions. So the spectrum that was discussed, same thing I've just presented in a different format, that if a FS is prepared on a going concern, but the going concern is inappropriate, give an adverse opinion. EOM, in case the FS is prepared on a realization basis. So client is also agreeing, we are also agreeing that it's a no going concern. So it is prepared on a liquidation basis. Then give an emphasis of matter paragraph and an unmodified opinion. So opinion is still okay, but given EOM, emphasis of matter. And obviously this is subject to the fact that it is disclosed properly in the financial statement as well. Next is the unmodified opinion where material uncertain paragraph is given. So we are talking about the spectrum beyond close call. So yes, if there is a going concern issue, material uncertain exists, adequate disclosure is made, then give a material uncertain paragraph, separate paragraph, add that. And if there are material uncertainties but management is unwilling to make the disclosures, then give an qualified and adverse opinion as the case may be. Okay, so that is already covered, so not going into detail here. Some indicators. So morning we were discussing, what are the indicators? Financial is not the only indicator. So just examples here: net liability position, net current liability position, withdrawal of support by creditors, bankers, etc. Negative operating cash flows, adverse key financial ratios, operating ratios. Any management doesn't have the intention to continue the company. Let's take an example. It's an MNC, a subsidiary of an MNC, and now the MNC is saying, it's not a very big volume. Let's do one thing: move the supply chain or manufacturing to some other country. So there's no concern because the MNC is not willing to continue. They don't want any business here. So it's a no going concern example. Loss of key manual person without replacement, labor difficulties, shortages, so etc. Others is under insurance, uninsurance. So in case of major catastrophes, changes laws and regulations. We discussed an example in the morning and in the afternoon session both. Pending legal matters, etc., non-compliance with statutory requirements. So these are some examples of indicators. Obviously, these are indicators. At this point in time, it indicators. Then you have to assess and conclude whether you're satisfied or not satisfied. And then evaluate where we go in this spectrum here. Issues, what are the observations around the material uncertainty paragraph? Okay. One is obviously the obvious thing. Give both. One is what is the uncertainty and how that is being addressed. What are the mitigating factors? Both have to be given in the paragraph. Okay, just don't state the uncertainty and leave it. If there is a mitigating factor, add that as well. Next is audit evidence for the financial capacity. So what happens in many cases, we get a support letter. So it could be support letter from the holding company or from the promoters as well. So obviously we need support letter, but that has to be an unconditional support letter. What we have seen in many cases is it is conditional, saying that yes, I will try to support the subsidiary to the extent of X amount. Then it is restricted. Then you have to evaluate what is the requirement of this company, whether that will be enough for that as well. Okay. Second is what is the date of that support letter also. That is also important. When are they giving? Are they extending it for 1 year from the date of signing? Like we discussed about the going concern in the morning, that it should not be. So technically the standard says 12 months from the balance sheet date, but we have to extend it from 12 months from the date of signing. So similarly, we have to assess the going concern 12 months from the date of signing. So is that support letter also is 12 months from the date of signing or not? And most important, are we assessing the capability of the company who is giving the support letter to us? So I've come across a case where we got a support letter and we were almost willing there to conclude, saying that yes, it's a going concern now because they have a support letter. But when we called for the financial of the holding company, we got to know that is also an issue, going concern issue. He himself is a going concern issue. How can he support us, right? So that doesn't make sense. So you also have to demonstrate. This is a very big concern. A lot of times people are just taking the documentary evidence of a support letter, but they are not assessing the, whether the financial capability is there or not of the holding company or the promoters to give it. This becomes a practical nightmare for us, an auditor, to assess when it is a promoter driven. How do you check that? So that is a nightmare. That is a practical challenge here, but yes, you have no option. If you don't want to rely on that, then go for projections, alternative stress tests, etc. Support letter is an easy way out for us as an auditor, because someone is giving and it's easy to verify someone's net worth. But promoter case is difficult because he will not show you all his financial liabilities, his financial position, right? We are not only interested. So many cases we have seen that promoter saying, okay, I'll do one thing. I have two, three land banks. I'll show you that value and close basis that. But you don't know the liabilities against that, right? So it is incomplete. So you have to assess the complete net worth evaluation to see whether he can support or not, right? So it is a nightmare, I agree. It's a nightmare if it is promoter-based, you're concluding going concern as a mitigating factor based on the support letter of the promoter. It's a nightmare, but yes, that is a way out. Ensure CARO reporting is synced with the material uncertainty paragraphs. What we have seen in many cases is material uncertainty paragraph you have given, perfect, but CARO says something else. There's a specific reporting on material uncertainty also, based on ratios, etc. But that is not in sync. So ensure that both are in sync. Wordings may not be same, but at least the messaging that is going out should be the same, right? So that is another issue. Work on projections, we spoke a lot about work done on estimates in the previous session, but yes, a lot of issues are there. So any estimates, there are two things that is mandatory required as per the standards. One is retrospective review of estimates. That's nothing but a look back analysis. So, let's take an example. This is a second year client. Last year also I faced a going concern issue. They give me a projections. Now I'll see in the current year, what was the projection given for current year. And I'll compare with the actual results of current year and to see how much is the projection reliable. How much can I rely on the management? If the projections and actuals are way apart from each other, then there's an issue because I cannot rely on management estimates, right? So I'll have to deep dive, look into the estimates given last year with the actuals and see what are the variance reasons and try to come up and see whether the management assertions or whether projections are reliable or not. That's the first step. Retrospective review, look back, okay? That's the first step. Secondly, obviously we spoke about it is biases in current year estimate. So yes, management projections playing around is very simple. Whether management has given good projections reasonable or not based on our understanding of the client and of the industry. We have to evaluate that as well. So let's take a second. If you have seen on NAFRA orders, there's a lot around projections. So one of the orders say that, the historical evidence said 10-15% growth, and in the projection they've assumed 100% growth. There was no justification for that. So you cannot just put in any numbers and close it, right? You have to evaluate. So there is a possibility of biases in estimates in the current year. So you have to challenge those estimates. Whether it's challenge sense is the estimates is making sense. If not, run your stress tests, etc., and evaluate, whether the projections are reasonable based on historical data. And if something is going away, for example, he's saying that no, next year 100% will be a 100% growth year on year. What is the basis for that? And can we justify through alternate route? So have you seen that expansion happening at the PP level? Then the manufacturing capacity is not growing. Then how can you say it is a 100% growth, right? So you have to challenge that. So that's why a lot of, this business understanding, industry understanding becomes important here. Okay? Okay, so far? Okay. Wordings on going concern. So here we are saying going concern is appropriate, but there is some material uncertainty. So here we start with we draw attention to. So like an emphasis matter, even in material uncertainty, we can say draw attention to. We can draw attention only if some matter is disclosed in the FS. If not, then we cannot draw attention. So we cannot go through a EM route. Then you have to go to a qualified or adverse route as the case may be. Okay. So here, so just an example that, I'm just giving the indicators here. Accumulated losses is there, net worth is there. I'll share this slide. Don't worry. Yeah. So, accumulated losses is there, net worth is eroded, current liability exceeding current assets. So I've just given all the indicators that is hurting me. Then I'm saying, yes, it is an indicator of material uncertainty. Then I'm concluding that, yes, I've got a support letter from the holding. So I'm giving the mitigating factor as we discussed. I'm giving that mitigating factors. And I'm also giving a comment on the projections that I also got the projections which are reasonable. And basis that I'm saying, yes, it's still a going concern. There is uncertainty, but there is still a going concern issue. It's still a going concern. Okay? Just a question here. Where an entity does not have material uncertainty regarding the ability to continue as a going concern, should the management responsibility para continue? Going concern issue, should we drop the management responsibility para, yes or no? We should continue. Because management responsibility does not, it doesn't depend on our assessment. They have to fulfill their responsibility, right? So that we still have to continue. Only in case of disclaimer, we remove these paras, some paras. We'll look at the other slides, but yes, otherwise we need to continue the paras. Now we go to the next topic, emphasis of matter and other matter paragraph. What is the difference here? So emphasis of matter is drawing attention to something that is already disclosed in the financial statements. So in that case, we give an emphasis of matter. But a word of caution here, it's not a substitute to a qualification, as we discussed, So the first point, modified opinion. That is the NAFRA order, saying that, you cannot, one is overarching use of emphasis of matter. And secondly, trying to, suppress qualification by replacing with an emphasis of matter, saying that, arre, maine kuch to dala audit report mein. It doesn't make sense ki main kidhar dala hai, but maine kuch to dala, so I'm okay, I'm safeguarded. That is not in concern. Qualification is different and EOM is different. EOM is just drawing attention. And qualification is saying that, this is not true and fair because of this para. Okay, so both are different. So it is not a substitute. Emphasis matter should not be a way out or a substitute to the modification that you make in the audit report. It's not a substitute to the disclosure in the FNS. So FS disclosure is separate. You still have to give all the matter. Describe the matter in the emphasis matter paragraph. Don't say that, it's disclosed there, so I'll just keep it brief or just refer saying that, refer this note for this matter. That's it. No, give that matter in detail and conclude on that as well. And next is, reporting in accordance with SA 570. So, it's saying that, yes, if there's some matter that is coming as per CAM, then go to CAM standard. Don't go to emphasis matter paragraph. So it's referring to that standard. So that will override the standard. Other matter is something which is not related to disclosures in the notes to accounts. Some examples we'll discuss that, but yes, it does not include what is required to be presented as in the notes as a replacement, saying that, something was required to be disclosed in the notes. Yes, sir, you had some query? Okay, sorry. So it's not a replacement to some disclosure in the FS, okay? And it is not a replacement to information that has to be provided by the management. Let's look at the practical examples here. Emphasis matter, common practical aspects, we start with, we draw attention to. So that is how we start, okay? That is for emphasis matter. Quantify the figures as applicable, wherever possible you have to quantify, okay? So if not possible, then we'll see that example. For example, in legal case, you cannot quantify because you don't know whether the order will be in favor or not. Obviously, you do a PPR analysis, whether it's probable, possible or remote. That analysis you do, you get it vetted through your tax team or probably your legal counsel, etc. But then, we can't conclude on that. But wherever possible, please quantify that amount as well, even in the emphasis matter paragraph. Like we said in the audit report that, we also give a reference of the previous year. If it's a repeated qualification, we say refer this, not required for emphasis matter. We're just drawing attention. So it is not required to repeat saying that, this was also emphasized in the earlier report. That is not required. Okay. Emphasis matter is related to, so I think this point was covered as an after observation. It is, emphasis matter should be given only for those matter which is already disclosed, but for which you want to draw attention. So if it is not disclosed, you cannot add an emphasis matter. So either ask the management to make the necessary disclosure and then give an emphasis matter, or go to the qualification route. So it's not a replace. So something has to be there in the notes to accounts. Then only you can give an emphasis matter paragraph. Okay. We discussed the last point that, yes, FS note is there, but it cannot be a copy paste. Emphasis matter and this cannot be a copy paste. You have to just customize it accordingly. So, reword it as the case may be. So describe the matter in detail both in emphasis matter as well as in the FS notes. When is the emphasis matter paragraph required? Some examples here. When there is an uncertainty, for example, legal case, outcome of a litigation or legal case, etc. So we are not sure whether it will be in favor of the company or against the company. So that warrants a emphasis matter graph. Significant subsequent event after the balance sheet date, but till the date of report. If there's a subsequent event which is non-adjusting, adjusting you have to, obviously take into account. Non-adjusting event, but it is significant, then draw an attention. Emphasis matter. We'll see examples, merger, demerger, etc. Those examples will be added in the emphasis matter paragraph. Early adoption of standard if permitted, then you can add it in emphasis matter, saying that, this was standard was appealed from this date, but I've earlier adopted. The management has earlier adopted, so that you can put. Major catastrophe, we took an example of COVID-19, so that is another classic example of, example of where we can put in the COVID impact, so that can come here. The current situation, COVID is not relevant, but yes, example is this Israel-Hamas situation or Ukraine-Russia war. If it is impacting your supply chains or constraints there, then that will come in the emphasis matter paragraph. Regulatory observation we discussed, not a substitute or a way to do the soft reporting, and widespread use of emphasis matter, compromises the effectiveness of the reporting. So don't use it as a substitute to qualification, and don't just keep on adding emphasis matter, saying कि सब चीज़ डाल देते, focus कर देते, बोलते user को देख लो. Doesn't make sense. It's not a substitute. Okay. Some examples here. One is of emphasis matter. One is revision of rates. So, for example, typically in a fertilizer company, the rates, at which the government will buy is announced after the year end. So technically, sometimes the audit report is issued before that. So you do a recognition based on the last rate, and then you say that, this is based on the last rate. If the rate comes, we'll do the actualization later, because as at that point in time, this is the best estimate available to us. So that is an example of emphasis matter. Litigations, pending litigations, classic example. Most frequently used emphasis matter paragraph is for litigations. Scheme of merger, demerger, fire, non-compliance of Companies Act. If it is not material, then we go to emphasis matter. Wordings, okay. So emphasis matter wordings, So first one is on the fire example, that, it's important for the users to understand there's a fire at the facility. So, we draw attention to this note which describes the effect of fire on the company's production. And the important thing to note here, we are saying our opinion is not modified in respect of that. So we are just saying that I'm not qualifying this. I'm just saying this is important for the users, so pay attention to that. And this detail explained in the notes to account. So that is the example of emphasis matter. Second example, litigation, classic examples. We are drawing attention to this pending litigation at this stage, authority. What is the amount involved? And we are saying that, as it is pending, no provision has been made, our opinion is not modified. So examples of emphasis matter paragraph. Okay. Drawing attention to the note, trying to quantify wherever possible, and giving reference, and concluding by saying, I am not qualifying, this is just an emphasis matter paragraph. Okay, a question again, is it advisable for an auditor to highlight all significant matters that affect the financials as an emphasis matter paragraph? Yes or no? Yeah, exactly. So that's a NAFRA obsession that, widespread use will diminish the impact of emphasis matter. So don't use it widespread. Look at case to case and evaluate whether it's required or not. If an auditor disagrees or is uncomfortable with our recognition, measurement or disclosure presentation, etc., can he highlight in the emphasis matter paragraph? Again, perfect, right? No. It's not a substitute to qualification. So if you're not happy with the recognition stand that the management has taken or measurement principle, then qualify. Or get the management to adjust it in the financial statements. You cannot just say that, no, I'll just put an emphasis matter and my responsibility is over because I've put in something in the audit report. That doesn't absolve you from your responsibility. You still have to quantify and give it in a qualification. Emphasis is not a replacement for that. Other matter paragraph. Other matter, so one second. So first we'll go to the examples and we'll come back. So examples of other matter. Physical variation not done. So, let's take an example. One is a COVID example given here that, for example, there was COVID, so you could not physically verify the inventory as on 31st. So you have directly gone to alternate procedures. So that is another example of other matter. So it's not going to emphasize matter, just putting it in other matter paragraph. How is it relevant here right now? So not exactly this case, but let's take an example of our appointment happening after the balance sheet date. So after 31st March, our appointment is. So you cannot go and do the stock count on 31st March, right? You are not the auditors then. So what do you do? So you can use other matter paragraph to demonstrate that, I was appointed after the year end, so hence I couldn't physically do. I've performed alternate procedures. Give it in the other matter paragraph. Next is comparatives not audited. So, we give another. For example, we are relying on some financial information which is management certified. Or maybe, last year it was an LLP where audit was not applicable, current year it's applicable. So you can just say comparatives not audited. So that is another example. Financials were audited by previous auditor. First we are the first year auditor. Last year someone else was the auditor. So we give that. This was audited by someone else who gave a modified opinion on this advert or give a clean opinion dated this. So giving reference to demonstrate that previous is not audited by us but someone else. SEBI reporting also we have seen other matter. For example, we say that the numbers for the last quarter is the difference between the year end or the full year numbers plus the 9 years LR number. So that is another matter, we put it in other matter in the SEBI LODR report. Secondly is, components, one is either audited by someone else where we are placing reliance, we call it as division of responsibility, saying that, I have not performed the audit, someone else, I'm just relying on him, or it's not audited by someone else. So that is another example of other matter paragraph. Some practical elements, or, one is what is the difference between financial statements and financial information. So financial statements is a full set of financial statements as per the applicable GAAP to you. And financial information may be an extract. Let's take an example. I have a subsidiary, say in Dubai. Now he will not prepare the financial as per Ind AS. He'll not give full set. So what he'll do is, whatever information has, he'll make it in a MIS format and give it to me. So that's a financial information, not a financial statement. So that is the difference here. So be careful with the wordings you use, nomenclature used in the other matter paragraph. Are you relying on the financial statement which is audited, or it's a financial information provided by someone, maybe a component auditor or maybe management certified. So use the correct wording. Gap difference. So Dubai example, it's audited by under some other gap, and I want to report in Ind AS. So I also have to evaluate the gap differences, if any. If not, then it's okay. But I still have to evaluate and document in the work papers. So there are different wordings for that. So for example, if he is giving the audited financials to me as per IFRS, I am converting into Ind AS, then I have to give that, he's audited under IFRS, I have converted it to this, and this gap adjustment I have been audited by. So that has to be given in the other matter paragraph, okay? That gap adjustment done by you, so that has to be given in the other matter paragraph. Issue here is about documentation. A lot of cases, one is this assessment of gap difference is not done, or we are just saying that, largely Ind AS and IFRS is same, so no need for assessment. So please ensure that that is also documented. Your assessment in detail should be documented of what is the basis of concluding there is no gap difference, or if there is a gap difference, how you conclude that there is nothing apart from this where there could be a gap difference. That has to be documented. In other matter, we give total assets, total revenue, etc. So that has to be without elimination. So standalone, what is the total assets or total revenue of that entity? I'll show you an example, but yes, that has to be without elimination. What is the standalone number of that FS of that component where I'm giving reference? Okay? That has to be quantified. ET assessment of not material to the group. So what happens here is, when we get management certified, so there are two options here. One is, so three options. One is audited by, so there is a console entity. I am the auditor of the main entity. There are three options. Component may be audited by me only. Component may be audited by someone else, some other auditor. And third option is it is unaudited, management certified. Okay. So yes, in case it is management certified, then we have to ensure that, whether it's beyond my materiality threshold or not. If not, then only when you can use management certified financials, when it is not material to the group. But that assessment of whether it's material to the group or not, that has to be documented in the financials, in your work papers. So that is another major miss, saying that, what is your assessment, whether that component which is unaudited, management certified, is it material to the group or not? Where is that assessment? That has to be documented, okay? Based on qualitative, quantitative factors. We'll see the examples and I'll show what I'm talking about. Modified opinion for previous year, again, just either reproduce or give reference to the audit report. So there, for example, we say, previous year audited by someone else, he's modified his report with respect to trade receivables, dated this. So that is an example. First year we discussed management accounts, best practice. So so a lot of challenges there in what do you mean by management accounts? So do you need a board approval? Do you mean management certified? Should CFO sign or just take a TB from that and just close it, consult basis that? What do you mean by management certified? A lot of dispute. Best practice suggests that, you should ask the company to adopt it in their board of directors. So though it is not audited properly, for example, a lot of jurisdiction have a threshold where audit is applicable. So in many cases, it's not relevant for us to get it audited in the local jurisdiction. But we have to assess that, if we want, how much it is for us, whether we want to get it audited, if not, whether we can rely on management certified. And what do you mean by management certified? It's the best practice says, we have to ask them to adopt it in their board of meeting and then give that management certified financials. So it's not only getting a TV and saying, I'll do the console. No, that is not allowed. So technically we would prefer, the best approach would be to get them adopt in their board of meeting, directors meeting, and then use that numbers in the console, okay? This we discuss. Examples, for example, few branches audited by someone else and we are placing reliance. Classic example for a bank audit, right? So we just write, we have, not audit the financial information of these many branches. And this is the total revenue as on date. This is the total assets as on date. And this is audited by someone else. We're just relying on that. So that is an example of, placing reliance, other matter paragraph example. Subsidiaries not audited by us, another example here. So saying that, financial information of subsidiaries jointly controlled, etc. Is not, we have included in the console, but is not audited by someone else. It is not audited by us, but someone else. That is another example here, okay? So here we are specifically trying to, just carve out a responsibility saying that, yes, these are the numbers in the console where I have not audited, but I'm just placing reliance on someone, okay? A word of caution here, this assessment of what is relevant for you as a console auditor and what is material for you, that is to be evaluated and documented. If you look at a lot of conversations from NAFRA, this is the next focus area that I'm looking at, saying that, and if you read, a commentary of NAFRA personnel, what they're saying is, you are just carving out 50%, 40%, though your standard allow, then how can you write in your audit report that, it still gives a true and fair view? Because you're saying 50% is audited by someone else. How can you place reliance on that? So that is another, upcoming focus area from NAFRA. So saying that, how do you ensure that there was adequate involvement? Those standards requires or allows you to do that division of responsibility, saying that I can still place reliance. But as a consolidator, how can you demonstrate your involvement in component audit? How you evaluated his competence, his capability, his independence, his ethical requirements compliance? How have you interacted with them? What are the group instructions you have given to him to ensure that he addresses your risk? What have you done on the deals that has come from him? What are the inquiries you have done with him? And are you satisfied with the opinion, or do you want him to work on something else? So there have been cases where if the group audit is not happy, there are two alternatives. Go back to him saying that this is not done perfectly, I want this to be done, perform additional procedures. And if you're still not happy, there is a cases where we also seen practically the auditor of the console holding entity saying that no, I cannot rely on him, I need to do the audit, or you get someone else to audit and give these numbers. I cannot place reliance on this auditor. So that is another focus area from NAFRA. Same thing, management certified. So here another example for that. Okay. So here I was talking about so the last line. In our opinion, according to information explanation given to us, these financial information are not material to the group. So this assessment is required to be documented. So yes, you have given a disclaimer saying that yes, I am relied on management certified accounts, but yes, giving that disclaimer, but it has to be basis your assessment of whether that component is material or not. If not, then you have to do the audit or get someone else to do the audit. Depends on management comfort. I've seen a lot of cases where even people are resigning, a lot of firms are resigning saying that I don't have adequate coverage at a console level. So they are resigning rather than saying that because I don't want to place reliance, I'm not comfortable with other component auditors. So a lot, many listed you'll practically see. What they will do is, in case there is, I don't know whether I should use this for wordings here in the forum, but a lot of cases, some risky components are there. So there they'll ensure that some local auditor or someone is appointed who is not that great. But listed companies, they want a good auditor, so that he is out of the scope. But a lot of auditors are taking that stand, saying that if I'm not comfortable, then either move the auditor or then give the audit to us. And people are resigning on this grounds as well. Practically, we have seen that. Key audit matter, another critical area. What is the key audit matter? So what is the most significant communications that you do with those charges governance? So it's a bucket of what are the communications you do with those charges governance. Out of that you see what are the most critical elements, and then you identify what is the key audit matter. Okay. So mandatory in case of general purpose financials, voluntary in other cases. Okay. So that is the example. Okay. What do you disclose here? One is what is the description, why you selected that item as a key audit matter, and how did you address that key audit matter? So yes, okay, something was critical, something was important, but how you address that? So that assessment is also to be given in the audit report. Okay. So this includes your audit process as well. So you are exposing yourself to saying that I'm doing this procedure for this area. So you're technically it's a little onerous because you're putting it in the audit report saying these are the processes I perform for this area. Okay. How do you decide a step-by-step approach to determine a key audit matter? One is look at what are the communications you are required to do to those charged with governance. So that is the universe for you. Okay. Out of then you shortlist what are the areas that required significant auditor's attention, where you spent a lot of time getting involved, looking at discussing with the management, those charged with governance, looking at audit, etc. So what is that area which requires significant attention? And out of that you then evaluate what is the most significant aspect. Okay. And this is how you come to the conclusion of what is a key audit matter. So assessment starting from what is the total communication that you do to those charged governance, to what is requires significant attention and what are you going to report. What is the most significant item? That is how you conclude on the key audit matter. Some examples, IT general controls. Okay. Now this becomes most important in case of a banks, because everything is automated. The entire environment is automated. So you're just placing reliance on automated. So a lot of focus is on what is the work you perform on the IT aspects, okay, general controls, automatic controls, etc. So the most common, if you see this CAM, is in banks, NBFCs, etc. ECL provision, another classic case of key audit matter, because a lot of complexity, judgment, and many times this amount is also material. So that is another example. Impairment, obviously, large, where the asset base is large, you will see impairment assessment as a key audit matter. Complex revenue recognition, the most common is revenue recognition. Provisions, contingencies, and complex financial instruments. Some examples of key audit matter. Some practical elements of around key audit matter. One is document your key audit matter assessment. So what do you mean by assessment? So we discussed in this slide that first you look at what is the universe, what are the communications you do, those charges, then you determine which required significant attention, which is high value, most significant for your audit. That assessment or that conclusion has to be documented. So as we were discussing in the documentation template, so you have applied some judgment to come at this conclusion saying that this is key for me. So that assessment has to be documented. Start with the entire list, put out what are the communications, and then document your assessment. What is a key audit matter and why? That has to be documented. And if something is not, document that as well. Another case we have seen is people are documenting assessment only for those cases which they have reported. But what about those cases where they have not even reported? So ensure that that documentation is also there. Okay. If there is no CAM, that assessment also should be documented. So that is also missing. Okay. CAM versus emphasis matter. We have a slide separately. I'll discuss that. There's a lot of overlap. We'll discuss that. Okay. Audit process performed for key audit matter. So you have to give the process performed for a key audit matter in the CAM, and ensuring that is in sync with what you have actually documented in the audit workbook. That has to be in sync. A lot of times we've seen people when writing in CAM, yes, I have just copy pasted from some good publication of ICI, everything will come. But when you go to the work paper level, it is not in sync. A lot of cases it's missing. So ensure that, as we discussed earlier, use reference material great, but ensure you are customizing it to your requirements, to what process you have actually performed. And also look at it from a holistic perspective. So if you look at the last point, a lot of cases, let's take an example, it's a listed client. You have no option but to comment on the IFC, right? But this assessment of design and control testing is not coming as a key audit matter response. Doesn't make sense, right? You mandatory have to do a TOC, you have to do a design and implementation assessment. Mandatorily you have to do, you have to report an IFC, right? But that is missing in the CAM. So ensure that that is in sync also, and that coverage is adequate. What process you are performing is adequate or not. As I told you, one is obviously audit report is public domain, but for CAM matter, you are also giving what are the procedures you have performed. So that also has to be adequate. A lot of judgment is required of how adequately I have covered, because you are talking about CAM, which is a signal matter, not only for those charged with guns, even for user attention, you want to put it in CAM, right? So that has to be, a lot of investment is required at this to determine CAM and to document that. Also what is happening is, please ensure you prepare a work paper saying that, these are the procedures performed, and give it referencing where are the respective work steps documented in your work paper. So give that reference saying that these are the 10 steps I have written in CAM, and these are the reference. Make a work paper to say where all you have documented in which work paper, how you have documented the working around CAM. Just an example, I'll share the slides, but just an example of illustrative CAM. When there is no CAM in the listed companies, there's no requirement to document the CAM assessment. True or false? Yes, so, but documentation is mandatory. Whether it's a CAM you're reporting, that is also mandatory. If you're not reporting a CAM, then why not no CAM? That also you have to disclose. So document in the work paper. Interplay between emphasis matter and key audit matter. Okay. So here, emphasis matter is not a substitute for CAM, vice versa. So, if there is a conflict, then the CAM matter will precede. So give it in CAM, yes. If it is a critical matter, signal matter, those charged with governance, you are taking to that level, it required your signal attention, then it goes to CAM. But something is not, you decided that it's not a CAM, but it is still critical for the users to understand, then only bring it to emphasis matter. So there's a, either this or that. So ensure that that assessment also documented, whether it should go to emphasis matter paragraph or a CAM matter. So CAM we discussed clearly that bucketization, those charges governance, signal time, attention, investments, etc. If it is not falling on that, but you still feel it is user important for the user, then take it to emphasis matter paragraph. Okay. When an audit disclaims an audit opinion, can key audit matter be stated in the report? There's a disclaimer on the entire report. So do you still give the CAM paragraph? Yes, no. Any views? Okay. So yes. So in case you are giving a disclaimer on the entire opinion of an entire financial statement, no need to give a CAM. But you are giving a disclaimer on a limited FSA, 1 or 2 FSAs, then you have to still give a CAM. So, but if it's a disclaimer on the entire audit report saying that, I'm not commenting on it, I am unable to obtain sufficient appropriate audit evidence and it is material and pervasive, so I am giving a disclaimer, then no need for a CAM. Okay. Other information. So what constitutes an other information? So it includes audit report examples, audit report, director report, etc., whatever you publish, which has financial information. Ensure that you plan in advance so that this is coming to you in time and you do the assessment here. Okay, and obviously take a LOR also. So what you are required to look at is material inconsistency between the other information and the financial statements, other information and your knowledge about the company. So any inconsistency you have to highlight it to the management and get it changed. Okay. Okay, this is the reporting requirement. add a statement, what is the information, identify what is the information available, give a statement whether describing what are you, whether you got it before the report date, after the report date, whether giving an opinion or not, you're not going an opinion, etc. So let's look at practical examples. So what are the aspects, critical aspects around other information? Testing of other information should be there in the audit report. So this was covered in the NAFRA slide earlier as well, that you also have to put in. So just having a copy in your audit file will not suffice. You have to do the testing and demonstrate that actual testing was done, and you are comfortable that there is no material inconsistency, or if there are consistencies, you also have to ensure that these are rectified before your report date. What is happening is many cases, one is no testing is done on the other information. So there is a example given in the guidance note also saying that these are the examples where you can even say that I have not received it, so I'm not commenting on it right now. That is okay. But a lot of cases people are still giving a comment on the other information, but no testing is there in the audit report. So ensure that you get it and then you report. Otherwise, don't report itself. Okay. Okay. Qualification. Okay. Other information also in case for example there is a qualified opinion, and in the other information may also have an impact because of that qualification. So give reference to that qualification. One or two just give it in summary. Multiple qualifications are there, then give reference saying that basis as per the matters described in the base of qualified opinion. So if something is there in the qualification opinion which may impact your other information, so give reference also, or reproduce in short if one case. Factual reporting here, so no copy paste error again. So for example, BSR, BRSR is there. So just ensure you write it. So whatever is applicable, look at it, what is under the information, and then update as required, as relevant. Testing of other information is after the report date. So if you look at the standard, it says that yes, there is a possibility that you may not receive it before the date. You can do it, you can receive it after the report date as well. But in that case, it still poses the onus on you that whenever you receive, you need to do the testing and you need to communicate to those charged with governance if there are misstatements. So what is happening is, yes, in case we get it, still that is documented in the file. But what about cases where it is issued given to you after the report date? There is no follow-up done, or there is no compliance done. So ensure that even if you receive after the report date, though you have concluded in the report date that I have not received, so I am not giving an opinion on this. But even if you receive after the report date, you are still legally bound as per the standards to look at it. If there are any mismatches, have to communicate with management those charged with governance. So that is another major miss that we have seen. Some information, some examples of unmodified opinion. We've got the other information before the report date. There's no misstatement here. So example, company's board is responsible for other information. What does the other information comprise of? So it comprises of director's report, annual report, etc., but does not include financial audit report. So we are saying FSN audit report is not part of the other information. And we are not opining on that. So next is we are not going to opine on that. And we are saying that, based on the work, we report that we have nothing to report in this regard. So we are looked at it, but there's no, we don't have any observation around testing around the other information. So that is an example of clean other information para. This is another, where we are saying that, whenever it is available, I will review it. The example I was quoting, whenever I receive it, I'll look at it. And yes, if we conclude after reading it, if we conclude there's a misstatement, we will communicate with those charged with governance. So I'm saying that yes, I have not received till date, but yes, this is the para whenever I receive, I'll still test it and give you an update to those charged with governance. That is another example. Okay. Information will be received after the report date. Another example. I'll share the slides. You can have a look at it. But these are examples even given in this, so not an issue. But still, I'll share the slides. Misstatements is there. So you have got the information, but there is misstatement, and management is unwilling to rectify that. So you are just giving that here. So we are saying that we have performed. There is a misstatement, and you describe the misstatement in detail. So that is an example where you've got the information before the report date. You've done the testing, and there is a misstatement. So you're just highlighting what is the discrepancy in the other information. Obviously, first path would be to go to the management and ask them to rectify. But if they're unwilling, then we have no option but to use this route. Some practical elements, management responsibility paragraph. So, here what is the management or those charged with governance or board of directors? Generally we use it interchangeably, but look at what are you reporting to? Who is the management in this case? You need to assess that. Because, management responsibility, technically, for example, let's take an example. Those charged with governance are not responsible for the preparation of financial statements. They are overseeing the financial reporting, but not preparation. Preparation is not their role, right? So you carefully determine who is management for your purpose in the audit report. Audit report, there are two options here. Auditor's responsibility. Either you can give it in the main report or you can give it as an annexure. Most of the cases, what I have seen practically is including in the report only. Some firms are giving it as an annexure. That is only because the report otherwise becomes too lengthy. So that is the only difference here. But doesn't make sense because standard permits both the options clearly given in the standard. Auditor responsibility, there's a, if IFC applicable is there, one of the para changes because you are commenting on the internal financial controls as well. So, carefully evaluate and assess as required. Are you just going to comment on the internal controls or not? IFC applicable, there's a different para. IFC not applicable, different para is there. Your responsibility will change. Our responsibility will change. Okay. In one case, we just have to comment on the design. In other case, we are commenting on the effectiveness of control as well. So that para changes. So ensure that you also look at it and change, update accordingly. And cross-referencing to IFC para. A lot of mismatches, or sometimes it is just written XX. We just highlight it but forget to update the reference number. So ensure that cross-referencing is not there. Housekeeping change basically. Report and other legal matter. Okay, 1 second. How much time we have, sir? 5-10 minutes. Okay. Report on other legal regulatory requirements. So this is just standard. So we'll directly jump on to practical elements rather than covering the theory. 11E, I'll just quickly explain. I just covered it. For example, let's read this. This is 11E. Very complicated. What is this thing? Whether the management has represented best of knowledge, belief, other than the very complicated. So simple example. Let's learn at this. Let's look at this picture. The first, this is the reporting entity. So this is a company, the main company, that's a funding party or a reporting entity. It gives funds, loans or invest in another company with their understanding that this intermediary company will further lend, invest or provide guarantee security on behalf of the original company. If that is the case, the first party we have to report under 11E1. This is very complicated here, but if you simply understand it, this is the reporting entity, the first one, who is giving the funds to intermediary for onward giving it to someone else. And just observe one thing here. In the first transaction flow, it's fund, advance, loan, investments. So actual flow of money is there. But in second leg, it can be fund investment or it can be guarantee security as well. So it could be fund-based, non-fund based as well. So that's a simple way to understand, but it is at the instruction of funding company. This 11E assessment is very critical because what is happening is, it is not only for a related party. You can have a non-related party, but you can have an understanding saying that, you on my behalf, you give money to someone else. So that is also covered here. So you have to, it's like we say in lifting of corporate wheel. You'll have to go one step beyond to see. So, you have to go to fund flow statement, see, understand the rationale. Business rationale is very important. So your professional skepticism becomes very important. 11E1 is simple here. Funding party is there. It is given to intermediary for onward submission. The first leg is funded. Second leg could be funded or non-funded. Okay. Second, 11E2, we are the intermediary now. We have got funds, money we have got, and we are lending, investing, guarantee. So funding is coming to us, and we are giving it to someone else on behalf of the original party. So if we are the intermediary, the reporting goes in 11E2. Okay. But first leg is funding. Second leg could be funded or non-funded. Simple explanation. Okay. Third is nothing but whether anything has come. So third is management representation has to be given, taken from the management, and whether we have come across anything which says that we cannot rely on management as representation. So that is it. Okay. Audit trail. So we have to report on audit trail. It should be reported throughout the operated throughout the year, not only at the year end. So it has to be throughout the year. So if it is even for a mid period, you report accordingly, saying that it was not there for this period. Okay. We are not an expert, so ensure that you involve experts, CISA, DISA, etc. Because we are not capable as an auditor. We are not capable to look at what is happening at the database level, at that level. So ensure that you evaluate experts. It should be evaluated for operating for all transactions. We cannot say that these two software is okay, but one software there is no audit trail. So ensure that it is operating for all softwares used for the audit. So that scoping of what are the softwares which produce information for financial purpose, that is also important here. So only directly we cannot go to testing. We have to see what all is relevant here. What are the inputs relevant and what are the softwares, and then after the scoping you decide and then do the testing of whether we can do or not. Next is, trail is not important, whether it's being tampered or not. So trail is there, but it is being tampered throughout the year, then that is also a qualification. So, ensure that trail is also there and it is not being tampered with. And data preservation. So it has to be, maintained for 8 years. So ensure that you also comment on that, whether it's being maintained for 8 years or not. some practical elements here. Evidence has to be documented of verification. So, you cannot just conclude that, there's an audit trail available. Take screenshots, take audit evidence to demonstrate that this trail was there, operating throughout there, and it was not tampered with. So, have that evidence in the in your audit documentation. Ensure that the trail is documented, enabled at the software level and database level. Many cases what we have seen is it is there at the software level, but at a database level, it is not active. The audit trail feature is not active. So it doesn't make sense. So ensure that it is there at the both the levels, software level plus database level. Both has to be operated. Then only you can comment positively. Third party, in case of third party is involved, then take a service organization report, type 1, type 2 report, and place reliance on that. Obviously, you have to evaluate the scope, whether the scope is adequate or not, but then you can place reliance on someone else's work. That is there. Retention, okay. Retention of original copies, okay. So overriding of audit trail, for example, trail is maintained, but then that backup is loaded every day or refreshed every week and replaced with the new backup. Doesn't make sense because records is not being maintained. So qualify again. If audit trail itself is not maintained, then question of retaining it for 8 years is also not relevant. So that is also obviously have to be qualified. Console report, you also have to look at individual comments in the individual components and then see what is the impact. So take qualifications from all report and bring it in the console report as well. Illustrative examples, we have a guidance, so we have just taken from there, so you can have a look at it. It's directly picked up from the guidance. Institute has come up with a lot of cases. In fact, I have covered 3 or 4 cases. But if you look at the guidance, multiple cases are there with multiple examples. So a good reference material of how to report an audit trail. Okay, legal and regulatory matter paragraphs. Some practical elements here. One is, when we write, we also have to write except for the possible effects of matters described in audit report. So in every legal and matter paragraph, there are multiple paragraphs, okay? Every paragraph also you have to assess whether any qualification is there in the main report. Will that impact the reporting year? For example, let's take an example. You have given a material uncertainty paragraph, okay? A material uncertainty paragraph. So then it will impact saying that, we have to comment whether there is an adverse effect on the functioning of the company. There it will have an adverse impact, right? Going concern will have an adverse impact of the company. So this is also to be modified. So look at what are the qualifications or etc. given in the main report and adjust. One of the reporting requirements is, books accounts are maintained or not. But if you have a qualification around books or accounts, something is not being maintained or something destroyed by fire, okay, then this will also be impacted. So ensure that whenever any matter is reported in the legal and regulatory matter paragraph, look at what are the qualified opinions and whether it has impact on this reporting or not. Yes, no. Otherwise, you'll have to update. So you can use these wordings except for the possible effects of matter described in qualified opinion, base of qualified opinion. Okay. Backup, as we spoke about documentation, everything has to be documented. So all evidence, for example, books accounts backup. I'm just giving examples here, but yes, every conclusion that you have to have your audit documentation of how you have concluded that, something has to be qualified or something is not required to be qualified. We are comfortable with that. So everything has to be backed up. Adverse impact we discuss. Disqualification, we have to look at as on year end, So many cases what is happening is people are taking the declaration, 160 declaration on the first day of the next year. So it is to be as at the year end. So look at that as well. The date is important. IFC, a lot of cases, it's IFC is applicable for only companies incorporated in India. So if it's a foreign subsidiary, it's not applicable. So, that tweaking is not happening in a lot of cases. So, whenever you're reporting an IFC, just look at it. It is applicable only for companies reported, incorporated in India. This is okay. This first point, internal audit observation. So evaluate that impact on the audit report. This was covered in the earlier slide as well, NAFRA comment also. So being repeated here. That yes, if the internal audit is there throughout the year, he's come across a lot of qualifications. Then how can you say that my IFC is clean? So you have to reassess. So 2 things. One is take the internal audit reports during the planning stage. Okay, make a summary and do a assessment first at the risk level. What is the, for example, they're saying that, debtors, there's a long outstanding debtors, multiple debtors are not paying on time. Immediately you have to go at a risk assessment level, evaluate, look at the internal audit report and add a risk saying that, recoverability of debtors is a risk for me. So evaluate the implication on the risk assessment at a first level. So look at, so what is happening is, don't take it just saying that, I need to comply, I need to report on internal audit and adequacy, whether it's commensurate or not. So I'll just keep a copy and that's it. No. Read it, look at the implications on first risk assessment and secondly on the audit conclusion also. So, it is very difficult to justify saying that internal audit got a lot of comments on internal financial controls, but I am giving a clean IFC opinion. A lot of issues here. So ensure that, you look at internal audit report, document and assessment saying these are the findings And this is the implication. First is on risk assessment, and then after your testing, what is the implication on the audit report? Document that as well. Operational control versus financial control. So we are focused on financial control. So internal auditor scope goes beyond that. So look at what is the idea, observation coming out and whether it makes sense or not. So for example, one of the observation is so they're saying there's no alternate supplier. The company depends on only one supplier. It doesn't make sense as long as my supply chain is not impacted. So it is a operational control, but not relevant for me as a financial control. Unless the supply chain is constrained, I don't have to report on that. So that is okay. So evaluate financial controls and impact on ours as IFC and as an audit report. Okay. Nature, extent of timing. Okay. So we have to decide based on the findings, IFC report. When do you do the IFC testing? A lot of cases what happens is we want to close the financials quickly after the year end. So what we do is we do interim IFC testing. But the problem here is then IFC testing is done only for, say, let's take an example, till December year end. Last quarter we skip the entire samples. So your samples is not spread throughout the year. So ensure that nature, extent, timing is appropriately planned so that you have samples throughout the year, not only during interim audit. IFC is a very critical area where we have seen a lot of gaps. People are saying that, as per the auditing standards, TOC is not mandatory. That is not the case. If you are reporting on IFC and if you are giving a clean opinion, you have no option but to do TOC for every approach. Every significant FSLI item, every single assertion should be through a control approach. You can do the substantive approach, that is okay. But the first primary procedure for every area, significant area, should be a TOC. This is the biggest gap that we have seen. IFC is clean, but if you go to the work papers, test of controls is not done for all areas. What we also have seen is, generally people will say that I'll do it for P&L items, revenue, purchase, expenses, I've done TOC. Balance sheet item, I'll go to substantive. See the debtors confirmation bhejo, nahi hai, alternate karo. No, they are also testing of TOCs. Debtors may be TOC. You have to take comfort from TOCs for all critical areas. That's a biggest finding even from NAFRA, saying that control testing is inadequate. Biggest finding from NAFRA. And TOC is a focus area even in the current year for NAFRA. Okay, console report. Again, the difference between whether it's audited by someone else or you're based on management accounts. The para wordings change. So just look at it. And when you're concluding on something, look at it from a material perspective. So if there is a qualification in the component auditor, if it doesn't make sense to you, don't include it. So look at it, evaluate based on group materiality, whether it's material to you at or not, or whether it's applicable to you or not. Let's take an example. There's a going concern issue at a component level. Now, after consolidation, you are knocking off all the balance. If you are holding a console balance sheet is not, there's no issue of going concern. You need not reproduce that because it doesn't make sense. It's already eliminated. Doesn't make sense, right? Similarly, there's a small qualification in a component. But when you look at it from a group material, it is not material at a group component materiality level. Ignore it. Not so that assessment has to be documented. What is material to you at a group level, and then include it in the report. Okay. So consider relevance and materiality at a group level. Foreign adjustments, we discussed this, but yes, ensure that in case you're taking a console of foreign components, that gap adjustments is also documented. Okay, CARO report, just give the reference of, CARO report from components, bring it to the main audit report also, main CARO report as well. What are the qualifications? Last reminders, quick reminders. You use basis of opinion paragraph for modified opinion and basis of qualified opinion. So what is happening is the heading we are not changing. If it is a qualified opinion, the wording changes to basis of qualified opinion. That qualified word is missing. Excess is given. So, whenever we give an example, emphasis matter, we are saying XX, we say that, the financial note number may change later, but people are forgetting to update it in the final version. So, ensure that XX is updated. We refer to it as company, it's a trust, it's a LLP, etc., but we are still saying, company. So, audit report, obviously, most of our clients would be companies, but yes, if it's a LLP, non-corporate entity, customize it accordingly. Client stamp is missing. So, ensure that you take client's seal and signature, initials on all the pages, signature is there. Date and place missing in many cases, so ensure date and place is there on the audit report. Rounding off should be consistent. So, for example, we have rounding off as per Schedule 3. So, audit report financials are rounding off, but when you are bringing the qualification or in the main audit report, you are saying other matter paragraph for some components, that is full numbers. That has to be also in sync. So, if it is in lakhs, this also has to be in lakhs. Just ensure the numbers are consistent between what is the rounding of you have used for financials and what are you using for the audit report. Use of standalone console. So, for example, if it's an entity where there's no console applicable, we just say financial statements. If it has standalone and console, then use the wording standalone for standalone FS and console for console. So what is happening is the standalone word is missing, console word is missing in a lot of cases. If it's a company, then write just company. No need to write standalone. But if you have standalone and console, write the wordings clearly to demonstrate this is a standalone financial, this is a console financials. IFC, one or two cases, not many, but one or two cases I've come across where IFC is not applicable, but you will just continue the reporting saying that, IFC I've relied on other auditors. So ensure you look at applicability. Inconsistency between the numbers in the financial in the audit report. So ensure that is backed up also. Other matter, specifically other matter paragraph, where you're placing clients on other auditor or you're placing on, say, a component auditor or management certified. What is the number that has to be consistent with what is reported in the financial statement? That consistency should be there. Signatures, it has to be consistent. For example, you should not have client saying I'll do a DSC, but you are signing it physically, or vice versa. Both should be in sync. If he's signing physically, you also sign physically. He's signing digitally, you also sign digitally. General purpose versus special purpose, 700 series, 800 series. General purpose, we don't give a basis of accounting and a restriction or use paragraph, but we add it in the special purpose because it's for a limited purpose. So we add restrictions saying that, this is only for this purpose and not to be used by anyone without our consent. So that paragraph of restriction, one is the basis of accounting, what is the basis you're using for the accounting, and what is restriction saying that, this is not to be used for any other purpose, only for the purpose which I have defined, that is added. And the reporting on legal and regulatory matter is required in general purpose but not in special purpose. This is just a list of authority references available from ICAI for our reference. So any topic you want to deep dive, a lot of this is available from ICAI. Just compiled everything so that it's readily available. You can have a look at it and download and look at it from ICAI website. Just a reference listing, that's it. Questions, if any? Otherwise, I'm done. First, thank you WRC and the conveyors for giving me this opportunity, and I'll thank you all the participants for patient listening. I know it's Saturday, but thank you for staying back. Thank you.